Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So, got an interesting article here. Comes out from Bloomberg. I'll link the article in the description so you can read up on it. But it basically says Americans must earn $114,000 a year to afford a typical home. The income that potential buyers need has soared to record levels according to Redfin. So things have, as you probably already know, things have got more costly. Inflation's been up, although it's come down from its peak, but things are still expensive. You go to the grocery store, you go to find a car, you're trying to buy a car, whether it's new or used. Things are expensive. You go on vacation, you're, booking hotels or Airbnb. It's all up because everybody's feeling the pain, right? What pain are they feeling? The high interest rates. Rates are up. Loan products are going to be higher. Business owners are going to feel the pinch. They're going to pass on that those expenses to the consumers, right? Especially landlords, especially business owners, entrepreneurs, and so on. If they're really feeling the tightness from all these higher rates, you're going to see it in the markets, and that's where consumers come out and they say, hey, I can't handle this anymore, I need higher wages. They go back to the company and they say, hey, give me a higher wage. Maybe some of them increase the wages and some don't, and that's just a snowballing effect that keeps inflation higher. Until when? Until maybe when things get worse off, aka recession, hard landing. But let's talk about this article here. Really important and very interesting. Talking about Americans now have to earn $114,000 a year to buy a typical home. So it starts off by saying home buyers need $114K salary to afford a typical home in September, assuming a 7.2% mortgage rate with a 20% down on a median home price of only $412,000, right? We're not talking about $1 million home. We're talking about a $400K home. You need $114,000. To comfortably afford a home payment, a buyer should spend no more than 30% of their income on housing costs. Totally agree with this. A lot of people don't spend that amount. They spend more than 30% of their income on housing. They're spending 40, they're maybe 50, maybe some people 60, 70. That's insane, right? If you think about it, you might have heard, if you're into investing, right, you might have heard the concept of diversification. But, when it comes to stocks and investing in the public markets, you may diversify, but if you're spending majority of your income into your house and a lot of that money is going there, then how are you diversifying if most of your eggs are in one basket, which is that house? So the typical rule people like to use is 30% of your income maximum 30% of your income should go towards your housing costs. If you can get it lower, fantastic, right? And that's the misconception also. A lot of people think that housing, the house you live in, is an investment. It's not an investment. It's an asset, but it's not an investment. What do I mean by that? I mean that when you're buying a home, a true investment would be that you are getting some sort of return, aka cash flow out of it. So when you're looking at real estate, you should be looking at it from a point of view that, okay, if I'm going to buy this, can I rent it out? Can I earn some sort of positive cash flow from it? Can I make some changes into it, upgrades, where I can flip or sell it and earn a return? That's an investment. When you're living in your house, it's just an asset, right? An asset that you're paying towards, although yes, right, as inflation continues, as it rises, as the cost, the value of money depreciates, your assets go up in value. But you're spending 30% of your income towards that cost, you're not getting anything back other than just meeting and matching with the levels of affordability. So when you own a house, right, when you own investments, your goal, right, or sorry, when you own assets, I should say, your goal is to at least match or beat inflation rate year by year, so you can be in the category where you can afford things, right? If you can't, then you're going to be in the category where you can't afford things, and things are going to be unaffordable because you are not taking your money and it's not growing with the trajectory of how assets are growing. Because remember, if you keep that money in just cash, it's depreciating. Every year you're losing value. That's why when you look at the income inequality gap, you might have heard the saying, the rich gets richer and the poor gets poorer. It's simply because where the money is parked, right? A lot of people who might be, let's say, aka poor, have most of their money in just cash, and they need it for expenses, so they're not allocating it into assets to at least bare minimum, to match with inflation, with the affordability, with how things are going year by year, right? And just look at it, housing prices, 50, 100 years back versus now. You can see that a trend where it's going up, and what it's doing is it's matching with affordability. And at times, if you make good investments, then you can get some sort of nice return out of it, and you can grow your wealth even further up, where you have a portfolio that gives you enough cushion, enough buffer from the affordability level. So you're way above that, and you can continue to grow. So housing, again, I look at it as an asset, not an investment. The one that you're living in, right? You may own rental properties, those, and if the numbers make sense, those are proper good investments. But the one you live in is more of an asset that you're spending towards. Another thing to note also with housing is that the loan, right? People get fixated with housing so much, right? Completely ignore the stock market and other investments. There are other opportunities out there, like stocks, like Bitcoin, like gold, like silver, like bonds, etc., etc. There are many other investments out there as well. But everyone's so fixated with housing because it's probably the most simplest thing that one can understand. It's tangible. With the stock market, it's very difficult. But it's how you make your learning, whether easy or difficult. With the stock market, it can be quite easy if you just simply follow buying index funds, which follow and track the S&P 500, like for example SPY ETF, right? If you're allocating money into that, you don't have to decide whether do I need to buy Microsoft, do I need to buy Google, Tesla, is this a risky stock or not? If you're investing in index funds, right, you're investing in the broader markets, and if you believe that America is going to prosper over the years and grow like it has many, many years back and until now, then you're betting that America will continue to grow, which means those SPY, that SPY ETF that tracks the index 500 companies is going to grow as well, which is very likely, right? So you can make it easy. It doesn't have to be so difficult, right? So that's why a lot of people may shy away from housing. Now, the thing with housing is that the loan amount, right? If you're, let's say, getting a loan of $300,000 or $400,000, do a calculation of that's the amount you owe, and how much do you also owe in terms of interest over, let's say, the 30 years of your mortgage. You'll find out very quickly that your loan amount is $400K, and you're paying, let's say hypothetically, $300 or another $400K extra on interest payments. You're basically paying over 30 years, not $400K, you're paying $700,000 to $800,000 away to the bank. Here you go, right? So you basically want to expect, or you expect that your house eventually over those 30 years should get to $800K or higher, $800K at least, to break even or higher, to make some sort of money, to get some sort of return, right? So again, housing is, living in your own house. Yes, it's an asset, but there are other opportunities as well. So if you can try to bring that number, what you pay, which is that 30%. If you can bring it to 30% or lower, it will give you more room, more avenue to diversify and invest elsewhere. Housing doesn't have to be the only thing you invest in, right? There are other investments out there. And if you can somehow figure that out, then that's fantastic. That's great. But if you're, spending majority of your money, 50, 60, 70% of your income into your house, you're tied to that value and you're at the mercy of whatever the market does and how it grows for that property, for that area, wherever you're living in, and so on, right? So going back to the article here, it says Americans have never needed more than current levels and data going back through 2012 when a salary requirement was roughly $38,000. So in 2012, the salary requirement was $38,000. That has skyrocketed to now about $114,000. And this is not going to get better, right? It also says that the median salary in America is $70,000 according to the Federal Reserve data, right? So imagine you have $70,000 salary and all of a sudden you need now to jump up to $114,000. How are you going to do that? It's going to be really, really difficult, right? So things are getting more and more expensive. Now also depends where you live too, right? If, for example, you're in California's Bay Area, you're going to need $400,000 for a typical home, priced north of $1 million in August. New Yorkers needed to earn almost $200,000 for a medium home listed for $725,000. And then those seeking, let's say, sunshine and low taxes in Miami need about $140,000 in income. So you can see certain areas need more, certain areas less. Obviously, California, New York, way more. Florida, different scenario. Texas, different scenario, right? And you could see the advantages there. Now, these prices fluctuate, right? And does this mean that it's over? You'll never be able to buy a home. It's, this is not going to end well. Well, not necessarily, right? If you're planning and you're preparing and you're stacking cash on the side and you're doing things to eliminate your costs, you can get another window of opportunity. What is that window of opportunity? Well, if there's a recession, if there's a hard landing, from all the tightening that's happening, there's a possibility there could be a recession and a price correction, right? Especially if you think about it, a lot of houses around the world went up 100% in 1 to 2 years. And if you look at history, when prices jump that high, right? Especially, let's take, for example, Bitcoin. How quick are you to laugh at Bitcoin, to shine, to be negative on Bitcoin as soon as it jumps more than 100% and say, oh, that's a bubble, that's going to come down? How fast are you to do that? But you don't think the same way for real estate, right? So the mindset's very different. And it's very possible it can happen to real estate as well. Just look at, for example, 2008 as an example. I'm not saying 2008 is coming again, but 100% in about a year's time, there's got to be price reduction. There's got to be a mean reversion in prices, especially where mortgage rates are, where rates have got very, very high to high levels. So you can expect people who over-levered will come into the markets and may panic sell and bring in more supply and sell houses for a cheaper price, right? And especially if, let's say, we're heading into a hard landing recession and unemployment rate skyrockets, people lose their jobs, then that will also bring up more supply, which if you look at the supply and demand curve, Economics 101 will tell you that prices will alleviate and come down. So in other words, it's not all gloom and doom. There might be some gloom and doom coming, but there are also opportunities if you prepare well enough for those times, right? So if you believe that, yes, recession is the base case, your base case analysis, and you expect mean reversion of some prices of the houses, then hey, you might be able to purchase a house not for $400K, maybe less, maybe $300K, and that affordability of 114,000 may come down back to maybe 70,000. Let's just say, for example, right? But if not, right? If not to 70,000, if it does come down to by a little bit, it will at least give you some sort of opportunity window to get in. So anyways, I'll leave the link again in the description. You can read up on this article. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.